What's up, everybody? Getting a late start a little bit ago. Storm knocked out the internet today, so it's having a little bit of delay getting in here. All right, let's go. Okay, quickly, irrational analysis. We're looking pretty good to the upside on this post CPI move up. Market's moving irrational territory for NASDAQ and the S&P. This is pretty much what we call irrational trading. So anything I do outside of here, small positions. Since the majority of the move's already taken place. Looks like a bull long up on SPY. What's up, friends? Let me refresh this here. We go straight into the chill lo-fi music. Looks like we have a bull long up. Looks like we have a gap fill. Let me double check this hasn't been filled yet. Nice little teeny gap fill on the S&P. Double checking here. What's up, Franz? Good morning. Love all y'all. Thanks for all the support. Let's take a look at this. All right, it's quick analysis here. Yep, there is a gap fill. It needs to be filled. So the SPY gap fill, chill in there. Make a little screenshot here. We'll long up to fill the gap. Sounds like a pretty decent setup to me. I like it. What do you guys think? All right, let's go, let's go, let's go. All right, friends, how we doing? Yes, y'all can hear me. Let's see. We got a pretty decent. Resilience is all positive. DD is pretty good. It's a bull long up right here. Hedge pressure looking pretty solid. I'm taking some longs off of my and my bigger account. Up longing right at the open. Up about $1,000 already on this one. I'm going to trade it just to the gap. The R&R is pretty good, at least to go there and come down. Though we are outside of DD bands range, so this is irrational. So I'm not going to go in there and jump in with the super long. Big position trade. Breaking hedge pressure obviously going to close down that trade. This is a pretty simple day today. Guys, Rocket Scooter is... Come on. Where you at? Why can't... What's going on here? Oh, let me just remove it. It's overlapping. That's why I was doing that. So we are, DD band is right about here, give or take. And the lower one, let's just kind of take a guess, probably about 4.8 and some change right there. Okay, let's get QQQ really quick. All right, quick analysis. Love y'all. Welcome to the stream, everybody. Smash the like button really quick. Yeah, trade because your proffer has cleared your account from yesterday's outage. Ooh, are you with it's Arithmetic, right? That was out. Who are you with? Was it Apex that was dealing with that? Or Top Step? One of the two. Top Step? Yeah, it was Top Step, wasn't it? QQQ, belong up, shit across the board, love it. Okay, UVXY. Let me double check Discord to see if we got some of these hot fixes coming in. So futures is a go, you guys. We officially are partnering with a futures broker. What? And this project's kicking off. We're staffing up for it. For real. It's coming. So you guys better buckle your britches. Oh, dude, 2023 is gonna be massive for this company. Massive, Tony. UVXY looking pretty solid in here. He hasn't fixed it yet. It'll be out probably maybe time we look into it. Okay. Let's take a look what's going on here with the oh, here we go. UQQ, hedge pressure. Should I take a small stab at this with some micros on the ETF? We are cautionary inside of DD bands, yellow light, so that's good. Where are my red green lights here? I delete them. Just redraw them, I guess. Where are they? Where did I put those guys at here? With Nasdaq, it's probably going to be about right here, give or take. Oh, down there somewhere. Okay. Let's go ahead and read the news, see what the actual data came out to look like. I was reading it on my phone. So we'll check both these, the year over year, month over month. The month over month came in kind of right at par. The year over year came in, again, slightly down. Now, again, we do have a new way that this is measured. So this is another thing to take note of. The way that they measure this only looks back a year now instead of 2 years. So it kind of smooths out the data a little bit. It's a less drastic change because you're no longer digging as far back into COVID, essentially erasing that delta from year over year. If you're only looking back 1 year, or the CPI numbers, you're not going to see as big of a change. But the actual is still coming in 0.4 month over month. 4%. It's kind of a non. I would consider this mostly a non-event. The market's gonna be sensitive to it. You expect inflation to still be coming down because people are getting unemployed. Unemployed folks now, unemployed non-essential labor will bring wages down drastically, but unemployed essential labor will have two residual effects. Number one is less people with less money spending things always drives inflation down. Less people with jobs always drive wages down, but also less people working is less people making things, so the supply comes down proportionally with the demand. And if it is disproportional, then you'll have effects that would be hard to read. Let's keep that in mind. Here we go. Ooh, looks like this is pulling back really hard. This Nasdaq is just shit in the bed today. Okay, we did actually start below hedge pressure, so keep that in mind. And this is trying to retrace a little bit of this. Let's see if we got anything that I like. It just pulled back really hard. Okay, resilience is still positive. DD still positive. Maintain that bull zone. Looks pretty good. Let's look at IWM. Should I take a long from here off of this hedge pressure? Should I put maybe 5 micros on it? Maybe. Let's do it. Hold on, wait. Don't push that button yet. That's moving super quick today. Wow, that gap is feeling really hard today. What do we think? Okay, resilience just plunged. Okay, that's pretty cool. Were you able to trade the rocket scooter? Absolutely, 100%. By the summer, you'll be able to trade futures and equities products through rocket scooter. We're doing both at the same time. Projects kicking off. Trying to get both of them. What an interesting dynamic here. Hit that top DD band, market starts pulling back. So their SPY is inside the redistribution zone, and this is rejecting half gap, could even fall lower. This is technically a hedge pressure break, so be very careful. 412.50, this is certainly not the best deal in the world. UVXY, so we'll check see if a hedge break there. Not yet. It opened actually at the same spot. Okay, so this is a very interesting setup here. I don't dislike what I see, but obviously the signals aren't there for me to take along, so I'm not going to do anything yet. But I waited. Why is this free falling? The data came, the data came in. I wouldn't consider it terrible news. The data came in mostly flat-ish. You would expect, as you're laying off more people, for the inflation to come down a little bit further, right? Because less people competing for jobs is better for the wages situation. So when you really think about how that works, right? More people with fewer jobs. JOLTS are coming down means there's fewer jobs. More people getting laid off means there's more people that need the jobs. Supply is down, demand is high, so there's more competition for the labor. So wages should be coming down. Well, if CPI, the biggest source of inflation was wages, and inflation's not drastically coming down, with both of those things should imply inflation's drastically coming down, then Wall Street would be betting that the Fed is not going to be so lax on their rate hikes. You guys follow that? Right? Want me to repeat that? Anyone not follow that? Basically, Wall Street's shock is, why wasn't it a better CPI? And it didn't come out as good as we wanted it to. Now, the secondary wave of inflation, we've been talking about that, is not particularly wage inflation. That was just a product of the immediate layoffs because of COVID. Right. The demand was really high and the supply was really low. People didn't want to go to work because of the COVID situation. So the people that did go to work were, well, workers are short supply. You need me to come work. I need a bigger wage. There's inflation after all, and I'm the only person available. Companies are like, fine, we'll pay you more. And that was the biggest mechanic for the inflation, not just the shortage of raw materials, but wage inflation. So now the characteristics of inflation are going to have a secondary wave. There's a couple other effects. It's not just those first effects. And the idea is that even though the Fed raising rates is not going to really control inflation directly, Fed raising rates is going to control Wall Street, which is going to put pressure on shareholders and board members to take action to control and become more efficient with their companies. Right, so raising rates is what forced people to get laid. Right, raising rates in QT scared Wall Street. Stocks came down, companies came off their high and got slapped in the face. Saying, okay, we're gonna start laying off some of these people. We can be more efficient. We're going through a recession. All right, let's lay folks off. And that was a great approach, right? Jay Powell had a good approach there, and we laid off non-essential folks, and now we're in the period of laying off essential folks, and that's the problem. When you do that, supply comes down and demand comes down both at the same time. Everyone smash the like button real quick. Y'all are here. Scroll down. I know you're busy trading and stuff. Scroll down, touch that little like button. Subscribe to the channel if you haven't already. Yep, futures through Rocket Scooter. We have 3 major projects coming through. One of them is like 90% a go. We'll be opening a vendor marketplace where we'll be hosting A-list people, like people you see on TV, will be hosting their tools in Rocket Scooter, like people that make really, 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 really cool shit. We're making the marketplace regardless, but we're going to work with someone really closely if we get through with this. Imagine expanding your tool base to a lot more cool stuff. That'd be really, really, really cool. And so we'll be able to host people's creations in a secure fashion. Server-side calculation that communicates output to the front end. It's secure. It's the only platform that will be doing that. A couple of them have tried to do the secure your tools route, like NinjaTrader, but you have to take a file and you obfuscate the code, right? There's a key to it. You have to pass a file to somebody. They open the file. You can't see how the code works, and you have to install this file on your machine. It's very 20-year-old technology, right? Installing files is pretty weird because these folks, you have to go to some weird website, download a file, a zip file, open it up, install on your machine. There you go. You have somebody's top secret tools on your platform. We're doing it server side. We built the technology to do that. So now people are very interested in hosting their you have a creation that you have that you want to share. You have a technical indicator or a method that you use. Obviously, if you use PineScript and TradingView, it's all on the front side. You can open the console or open the source code and see how it works. We have server-side guarded code so that you can protect your IP. So that's got a lot of interest from some major brokers and major folks in the industry. And now that we have that built, because we have built that to broadcast hedge pressures and things to you in the back end, people are taking notice. So we're going to have a marketplace where others will have very secure technologies on our back end. So that's project 1. Project 2, we will have equities trading. We're working on a particular pathway right now to connect to, I think it's like 20 something different brokers, TD Ameritrade, Interact Brokers, TradeStation, you name it, they're all there. The last one is futures, and that project is coming on now. So literally by 2023's end, we will have 3 major projects. And 2024 is all about automation. You have your own source code in here. You can create your own things, create your own automated trading, create your own automated signals. Alerts will talk to Discord. Alerts will talk to text message. We're going to do things that nobody's done. So stay tuned to the Discord call. It's going to be posting out calls for resumes. Buying spec these. No, Jeff. So hedge pressure break today. No entry for me. Anytime you break hedge pressure for more than 1 strike distance, it's a game over. Right. So here, resilience is down, which means half gap is going to be resistance. It's probably going to fill the gap to the downside. I could get pretty nasty from here. Until resilience goes up, I'm not doing anything. So I thought about pulling the trigger right here. I still didn't. I was kind of analyzing it, and things just started falling pretty quick. So nothing yet. When it says a gap fill move, I mean all signals point to a gap fill so far. Nasdaq is still kind of holding the fort though, so let's take a look at this. Trying to hang in there. Remember, Nasdaq opened below hedge pressure, so breaking hedge pressure and continuing to go is looking like its pathway today. Resiliences are lower, so this could trickle down a lot. So this could be a pretty nasty day to the downside. It's just noise at this point. It's random and irrational, so be very careful. Okay, let's test out the signal. Test server. Are you guys excited about all the launches? Imagine not just rocket scooters tools, but imagine the best AI, the best machine learning, the best whatever techniques in the modern world. Modern techniques. I'm not just talking about rinky-dink indicator sets. I'm talking about modern techniques will be hosted on rocket scooters. Somebody has a cool idea, cool algorithm, cool anything. We'll have the best of the best vendors out there for anything. Someone comes up with a new way to automate, analyze dark pool orders, automate, analyze unusual flow activity, create some kind of really rock solid signal off of that. We could tie that into the alerts, the rule assist, all parts of it. Automation, you can automate your trades off of it, everything. There's a lot of paradigms will be changing as far as trading platforms go. So the idea is you'll be able to program your own rule set for the lights. You'll be able to program your own rule set for the control. Like basically we've piloted all the different things. We didn't tell everybody, you know, for the last couple of years what we were designing. This was until we started leaking some of this to you guys last couple of months. But the rule assist is going to be ones that throttle and turn off your indicators. Like if you create a tool, you'll be able to turn on off your indicators, turn on off alerts, tie it into the scanner, do all kinds of neat things with it. The rule assist mode, and share your rule set and share all your different tools and be able to create alerts and all the other stuff that you'd want to do. But you don't have to go download some virus-ridden executable from some weirdo on the internet. It's all web-based. Will I have to be a coding guru to use RS automation? No, not at all. So the automation part will be as simple as programming a strategy. As far as creating your tool to automate, you'll have to be, you know, adapting and creating indicator or whatever rule set you have. Now the rule set could be person A's indicator flags this signal plus person B's indicator flags this signal equals my signal to buy. You literally just drop downs. If this and this, then take this action. And you would create an automation rule. Take this action. Oh, put a red light here. Take this action. Well, turn off zones. Take this action. Put a limit order. Take this action. Put drop stop. So that's basically that. Now, you can create your own indicators as well to create those signals, or you can just patch other folks together. And either way, it gives full control to the user. And the difference between, there's only a few other platforms out there that's attempted to do something like this, like Ninja being one of them, right? But Ninja is a front-end distribution. You have to take a zip file and send it to people. Someone says, hey, I have a top secret, super awesome algorithm here, check it out. You have to go to some website. Could be, you trust it, you have to download a file, open a zip file, all kind of things. You have to install it on your machine. You have to go tweak it, turn it on, add it to, very, very 2002, right? Ours is going to be all web-based. Ours is going to be on a mobile app. Ours is going to be done on the server in the back end. You don't have to install anything. It's just there. Once you're authenticated for it, just comes straightforward. So after the years went by, that's what we build. That's our product in Rockets. One of our major products in Rockets here is server-side code obfuscation or code housing, where you don't have to have front-end obfuscation code. Your secrets are protected. If you make something, you can share it with everybody. So I'm excited about that. The res signal is fantastic. Can you buy shares in Rocket Scooter? Well, technically you can. Rocket Scooter is a corporation, but they're not traded on the open market, unfortunately. Technically could eventually. People could be shareholders of Rocket Scooter. I'm a Rocket Scooter shareholder. I like this channel, man. This channel is so good. You guys, everyone here, throw some rockets in the chat if you're excited about the news. Imagine all those things coming through. Right, we have a fourth project that we're working on right now, which is historical data. They've been working on it since December. It's to transfer all of our historic data, outputs, inputs, raw data, all our database materials into one location, so we can create the what we call the historic part. Historic data would be like historic resilience, historic hedge pressures, historic liquidity maps, which will allow team number 4 to create the backtest area, and that will go into the machine learning part of creating new rules and going back and using AI to analyze those rules for their efficacy in trading. So essentially, focus 2, 1 and 2 is futures trading, equities trading. There's 2 different projects. Focus 3 is the marketplace. Focus 4 is historic data. All of that's coming this year. 4 huge projects. We're staffing up for it. So we're about to hit we're about 90 people away from our 4,000th user account. I remember when Rocket Scooter had 40 user accounts. Could never in my wildest dreams imagine 4,000. Projections are 10,000 by the end of the year. What's up, Ashton? What's up, baby? What'd you miss? Nothing. Hedge pressure break on CPI. I'm just sitting here chilling. Resilience is negative. Looks like we're going to fill the gap to the downside, probably. It's irrational, though, so I'm not taking a trade. Love that signal. Irrational signal. Take it easy. Chill out. All those lights are red. Oh, let me double check something really quick on the test server. All right, so here's the test server changes. Looks like, oops, let me do the alert. So looks like we got the alerts fixed on the test server change. So this is good. This is good. Perfect. QQQ hedge break. Let me double check this. QQQ hedge break. Perfect. Perfect. QQQ hedge break as well. YOLO. Problem is. Okay. Oh, by the way, would you guys like to see the words? I'll let you guys vote. This is how he did it. I originally, and let y'all vote really quick. So hedge break. Do you want to see the words, like, essentially he do it here, like if hedge break down, it says D, right? And this is all fine and dandy, but I'd rather, personally, I want to see hedge break and then the U and the D to the right. Vote really quick, right or left. You guys can pick. The more you use Rockseer, the more you realize how clutch resilience really is. I'm going to tell you, people always ask me what my favorite indicator is, and I tell you it's resilience. You guys the right? Okay. Quick, U or D? U and D or UP or DN? Do you want... do you need any more letters than U or D? Thanks for voting. Right seems like the way to go. Okay, and please use arrow up or down, or an arrow up or down. Oh, okay, hold on. Okay, because U and D could confuse with liquidity map. Arrow up and arrow down. Okay. Okay, let me do it real quick. Yeah, I agree, because U or D could be a different nomenclature for U and D. Okay, what's that mean? Like up. Yeah, but the colors, right? Red, green. Yeah, I love it. Whoever came up with the arrows, I love you. I'm gonna send you $1 million gift. I'm gonna send you 1 penny every year for 1 million years, or actually 100 million years. Give me your address. $1 penny a year for 100 million years. Get ready for it, baby. It's coming. I read something today in the news that says Americans dispose accidentally $74 million worth of coins in the trash. Can y'all believe that? We throw away $74 million just in money that needs to be reprinted. No wonder they're going towards a digital currency. We're throwing that hard mined metal back to the landfills in the ground. Yeah, you're welcome. J Pal, let's go. Arrows and colors, yeah? Okay, we'll do it. Red arrow down. Green arrow up. So that it's the nomenclature, right? Isn't confused with UD and liquidity map. Look at you, smarty pantses. This is what I'm saying. This is one of the coolest parts about Rockseer. You guys are being big part of the design of the platform. Oh, there we go. Hedge break back to the upside. Let's go. NASDAQ going to highs for the day. This is crazy. All right, well, let's look at this. Remember, irrational markets mean that resilience, you have to be very careful. Resilience loses any leading edge. So one of the things with resilience is that we don't assume that the index leads the stocks when you have irrational markets, right? Trying to help disinflation. I know, right? Throw your money away. Make the supply low and make the value go up. That works every time. Your idea, you guys designing a trading platform like some pros you are. So I'm gonna take it. Nothing yet. I don't like it. That nomenclature is confused. Okay, cool. The test server changes look pretty good. On that, awesome. So which of the new projects are y'all most excited for? Number one, So the historic data, as soon as they get that stuff set on the server side, we're going to build black box 2, which is going to create dynamic hedge pressure inside of here. So basically the teams that are working, the 4 teams, team 4, as soon as we wrap up getting the historical data compiled, organized, and in our hands, they're going to build black box 2 and put dynamic hedge pressure. So the bot calculation will be done here. We're also going to have, which again, futures data opens the door to DD bands, opens the door to all the rest of the irrational signals. Everything comes into here. So this is going to be a massive year. By the end of 2023, all of Rocket Scooter will be automated with futures trading, stock trading, broker partnership, A-list vendors, vendor marketplace. Let's talk about being the next big thing in this industry. Grand projections are we'll have 10,000 user accounts by the end of the year. Let's see if that keeps going. Especially if we partner with the broker, it's going to be amazing thing for me to trade all in one spot. Oh my God. Like, hello. Put all of it, boom, open up the DOM Rocket Scooter. I'm gonna be more excited, you guys. Resilience is back to being positive. Remember, irrational market, you have to be very careful. Irrational market resilience will be delayed, or could be delayed. Sorry, not don't assume that it will be. It can be. Typically, as the stocks move, the index follows the stocks, right? So SPY follows the index. If somebody's just liquidating SPY, it doesn't matter what the stocks are doing. They're going to get out of their SPY because it can trade independently. When the probability of somebody just liquidating a massive amounts of an index product in the middle of the day is very small because nobody just dumps their stuff to the market. They'll use dark pools if they need to. You typically dump your stuff to the market if you're getting squeezed or exercised on. That's exactly what causes midday dumps when SPY will deviate from the sum of the stocks or move first. It's the rare of the case, right? The stocks tend to move first almost all the time. When markets are rational, the stock market has a very low probability of being random to the point where someone's going to get squeezed in a surprise or exercised on. So when all these lights are green, you assume that the index is tracking the stocks, and resilience therefore is a leading indicator. When those lights turn red, you can't assume that resilience is leading. It can lead, it can lag, so we take it with a grain of salt. I need to have resilience be greater than 10 or less than negative 10 to give it a clear signal. Is this strong? Is this watermelon sugar? This is evoking COVID memories. Remember in COVID where you would get your to-go tacos from whatever store and then go sit in your living room and watch Netflix. You're watching Tiger King, eating your tacos, and you hear watermelon sugar like every other song. Every time I hear this song, it just brings back all those memories of COVID. This is the COVID song. I mean, this was the, because most of us were like chilling by the pool. Like I would get crawfish every week. This place I would do curbside crawfish, sit by the pool, drink my tequila, got my drink, got my sunglasses on. Watermelon Sugar sounds like a fun summertime song. You know what it's really about? It's really about naughty things, earmuffs, kids, about naughty sex things. However, you thought it was, you think of watermelon, sunshine, throwing frisbee in the backyard. Felt like a summertime song. Cobra Kai. Watching Cobra Kai. Dude, when Cobra Kai came off of YouTube, Red, and went straight to Netflix, I was like immediately in love with Cobra Kai. Is such a fun show. Like the nostalgia value makes it fun, but even standalone, it's actually pretty cool. They like Johnny's character being so deep and Daniel being the douchebag was like, I was like, that's right. I used to always say, I actually kind of felt bad for Johnny. He had it bad. In the original movies kind of painted him as like the 80s bro prick. But he actually his character was pretty good. You're going right. Brian was going where I was going with the explanation. You have to keep it somewhat PG rated with here, but I'm not gonna talk about my personal watermelon sugar experiences during COVID. However, These are like evoking those like COVID memories, right? Those vibes. What are you gonna do today? Go lay by the pool, eat crawfish, get drunk, kick your feet up, turn on your radio. I'll be honest, I don't follow a lot of pop music. You guys know me. I listen to a lot of metal. I listen to a lot of EDM. I listen to a lot of indie. I listen to everything, really, I guess. But I'm going to tell you, I was actually surprised. I started... Harry Styles, actually one of my favorite artists these days. It kind of has like evokes a little bit of David Bowie, evokes a little bit of like Mick Jagger. You get a lot of... a little bit of move here. He's just got that kind of, I think, that staying power. I think he was in a boy band or something when he was a kid. But I started there. He did a cover, and this is how I know. I was just like Googling. He did a cover of Peter Gabriel's Sledgehammer on the Howard Stern show. Dude, fucking nailed it. And that's like an epic song from the 80s. Everybody knows that song. And I was like, oh man, this dude can sing. EDC Vegas next week. I know we can't go because Nicole is going to be out of commission for about a week. We actually were going to go to EDC. You had hella shape during COVID? Oh, yeah. Work out every day. I hated working out with the mask on. I hate it. It was like the worst thing in the world. Even if you were by yourself in the gym, and no one is around you for like 100 feet, someone would come out and be like, can you put your mask on while you're on that treadmill? And you're like, ugh, I don't want to breathe my own breath. Those are, everybody remembers those days. And now I'm bringing back all those crazy memories. Everybody. March 2020. But didn't they just, I guess just recently, right? They declared COVID's no longer an emergency, right? This was something that recently happened? It's no longer a global health crisis. I think the World Health Organization finally classified it as no longer a crisis, right? That's recent. A couple weeks ago, right? No longer a pandemic as of 4 days ago. Yeah, almost 4 days ago. Yeah, I didn't know that. They did 4 days ago. This has been classified officially by the WHO as no longer a global pandemic. Again, as traders, we think, does that affect the market in some way? I think we're too far removed from the worst waves of COVID that I don't think that would have any effect on the labor markets. I feel like the stock market would probably have no reaction to that. But you always have to think, everything that has actionability, you always have to keep it in the back of your mind if it's going to have a possible effect on the stock market. Market doesn't care about COVID anymore, no. The way you would have to project it is, if it's no longer an emergency, will that get people back to work, or get people, because the deterrent would be like, okay, it's still an emergency. Maybe I don't want to go back to work. Maybe I'm still working from home. Or maybe companies are like, all right, our company policy is when the WHO says it's no longer a pandemic, then we'll make people come back to work and start opening jobs again. But I don't think there's any companies really in that boat. I think most companies have adjusted very early on to the pandemic. And so therefore, my conclusion, there's going to be no change. You always have to think, though, as a trader, everything you have to spin the cogs in your head and try to just, is it going to have an effect or not? Don't think it will. At least not in the US. It might have a bigger effect in companies without readily available technology to get you, to a salary via remote workplace, or even, more rural areas where your job can't be done online. Your farming or industrial type work, where the company just shut down because the owner just did. But still, though, it would be such a small subset of the labor force. I think it would have no effect on inflation or wages. But you always have to think of every angle, right? Don't leave any stone unturned. Analyze to the end. Now it's all debt ceiling, or what do you think? Well, yeah. I think right now, with the way that BRICS is going, America, the U.S. is kind of getting the blunt end of the shaft here with a lot of the global economic alliances that are forming, right? Now, again, OPEC had a control in the world's oil supply for many, many, many years, like what, since the 70s, they basically run the show. So the question becomes, is BRICS something to really fear in an economic sense? Working in the oil and gas industry, I'll tell you, being one of the biggest customers or the biggest customer of energy products, no one's incentivized to. We're like, there's a political side where people say, well, we've pissed off all those countries for the last 10 or 20 years. They all hate us for different reasons. Oh, crap. Well, but still, they can't do anything to hurt their biggest customer either. If we don't buy their oil, then all their economies sink. Most of them are already struggling already, right? It's a recession. So I think we're pretty safe. It's mutually assured destruction. If they do anything to harm their biggest customer economically, they need us, we need them. It's kind of stalemate. So I think that's one of the bigger problems people think about as far as world economy goes. I think in peacetime, I think that's going to have no effect either. Maybe during wartime, there could be sanctions against us or something if that ever happens. But no, peacetime, not afraid of that. Debt ceiling's gonna be a bigger thing. I think that's one of the bigger things to talk about. That and the effective quantitative tightening. The Fed reversing their policy decision. I mean, that's a big deal. The Fed is completely bending over to the banks, but not really. I guess that what I think the Fed is doing is they know they'll have to bail the banks out if they all collapse, and the banks got overly greedy and levered up in crypto, just like they did in the housing market during the adjustable rate era. And it's just a repeat all over again. Over leveraged banks blew up, and the Fed will have to, and the bigger banks are going out and buying all the toxic assets from these smaller banks that are going bust. But still, the Fed has to bail everyone out. They'll have to print money, and Treasury will have to sell debt for cheap and raise money and all this stuff. The Fed will have to print money again to bail us out. And I don't think anybody in the Fed wants to do that when they can start slightly doing it now. So doing a little bank rescue preliminarily so that we don't have massive collapses. So I think the Fed is still going to be controlling the show for the year. Market's going to listen very adamantly to the FOMC. It's even small changes. Basically, what you want to see, like inflation should be coming down worse, or it's coming down better than it is because of the layoffs. The fact that it's not just tells you that we've laid off essential folks, and they're bringing not only is. Let me piece. I love this analysis. You guys want to learn something cool? I'm going to put you to sleep some fundamentals. Hold on. Let's talk about labor market real quick. Let's go to dude, you're gonna have a blast in EDC. Waiting for resilience. That Nasdaq is just going high. It's crazy. I was reading a metric last night that said only about 40% of the stocks are outpacing the S&P, which means that just like which is kind of low for what it's been for the last couple of decades. 30-40% is what we've been seeing like in pre and post COVID era trading near 2020, where basically you have your big market cap or mega cap stocks are the ones really carrying the stock market. The bottom half, you can see the weakness in the Russell. It's very evident to see the weakness in small caps just comes from a higher risk perspective in the recession that we are in. And so, clearly it's the stronger companies that are going to do the heavy lifting. And it's not surprising that there's only about 40% of the stocks outpacing the S&P. So it really just shows that we're moving on, and I hate to say not FANGs again, but that's the same principle. When the FANGs used to carry the stock market, no different. You have your your upper half of the S&P is doing all the heavy lifting. Okay, let's talk about the things that you guys love to talk about. Right, jolts are coming down, which means available job openings. Either the specific position exists, so when it comes down, either the position doesn't exist anymore, they eliminated the job. A job can start within 30 days, meaning that they can get somebody onboarded very quick, and it's not like a job that is seasonal, right? So the job, like you're hiring somebody, the job is open, but they can't start till December, well, then that won't count. That each one of these bullet points mean these things. An active recruiting for workers from outside the established location that has the opening. So you're actively trying to fill the job. It's not just a job that nobody means. It's a job that somebody wants to be filled. It's not just a job that exists that you're like, well, we'll fill it next year. So it's a job that exists that needs to start soon that you're actively trying to fill. It tells that story. Jolts coming down, it means one of these three things is not hitting. So most of them are position exists and they're getting rid of jobs. Or they're not recruiting either one. They're just not trying to fill a job, or the job doesn't exist. So that's a bigger deal when companies are closing down positions. Right? When companies are opening jobs, there's expansion. When companies are closing jobs, you're laying people off. Okay, so continuing jobless claims, initial jobless claims. Initial jobless claims are when you just first get fired. Your first filing of unemployment insurance for the first time. Every time there's a wave, you have seasonal wave around the end of the year, you had 4 waves of unemployment, right? And this is companies, people are saying companies trimming their fat, right? And that's what this has been. Trim the fat, trim the fat, trim the fat, etc. There's a wave of layoffs. This is a number of claims, right? So a bunch of people getting laid off and fewer people are getting laid off. Bunch of people, fewer people. And so of the 4 waves, you can see continual is the number of unemployed people who qualify for the benefits in general. So continuing claims. So wave 1 got their jobs back. Wave 2 got their jobs back. Wave 3 got their jobs not back, and wave 4 not back. So waves 3 and 4 are people that are getting laid off that now can't get a job. One of the reasons that limited that to begin with is they wanted a lot of money for their labor. So that supply and demand imbalance brought inflation down. Easy to see. You lay people off. No longer is there more jobs than workers, and the workers can demand a higher salary. Now there's more workers than jobs. Jobs are coming down, unemployment's going up. Or unemployed filings going up. So there are people that are desperate for a job, and people that are locked into mortgages. They need a job pretty quick. Wages should be coming down very rapidly, which means inflation should be coming down very rapidly. And inflation is still pretty normal. We're not, obviously we had big peaks that have kind of subsided, but we're just 0.4% month over month. That's, I say normal, that's pretty high. That's high. Remember, the change is about 2% a year is what the Fed's trying to target. It's pretty high, 0.4% from month over month. So when you look at the CPI year over year, now again, this is the change of this reading versus a year ago reading. You can see that it's kind of flat, right? There's other mechanics besides the labor market. That's all that tells you, and that you guys can see that, right? You would expect that if just current amounts of unemployed people and no jobs to be filled, that wages are just going to plummet, and therefore it's going to bring inflation down, right? Prices are going to come down to match. Well, prices aren't coming down to match. Prices are still high. Well, there's got to be some other mechanic, which that's exactly what we forecast. We said as soon as you start saturating the labor market with unemployed folks and jolts are coming down, you're going to see its full effect on inflation realized, and then you're going to see the other effects of inflation. Right? Hit that like button, you guys. Thank you. So now that we're not seeing the CPI numbers just drastically change, right? The month over month is still pretty stable. I mean, it's slightly better than it was late last year, but it's still not coming down. I mean, it's still elevated. It can compare it to 2019, 2020, where we would get close to about 0.2 a year, right? 0.2 is great. 0.2 times 12, right? It's 2.4. It's about 2% a year if you just multiply that by 12. And we're sitting here at about 4% a year, a little bit higher. That's a lot, right? If you just extrapolate that number, and then clearly the year over year is reflecting a 5.5%. The Fed wants to target 2. So this implies the fact that, well, the Fed's first wave of let's induce some layoffs to bring inflation down. Okay, this is what they were able to accomplish, about 1 point year over year. What they accomplished with that tactic was about half a point month over month. We're still going to beat the 2% inflation. The Fed still needs to take action to reverse the other mechanics of inflation. So we're not going to hit 2% a year with a 0.4 month over month. Do y'all guys see that? So now as traders have to identify where the other mechanics of inflation. Well, you have to think about it. It's all supply and demand. There either must be why is the cost of something going up? Well, there's a supply versus demand effect. More demand versus supply, then prices will go up. Are we having shortages again? Are we having increased demand for things? Are we having increased demand for just some things? Like certain markets, like housing, have a very low supply of available houses and very high demand. People are still buying houses. Okay. Maybe there's certain markets that have a supply-demand imbalance in general. You would think that people would be spending less money as they're unemployed, like in general. If fewer people are working, people are going to be tighter with their money, spending less money on things, which means there should be more things on the shelves. You produced in that period a lot of goods and services. The shortages are gone, and fewer people are employed with money to spend, so fewer people are making stuff. So therefore, stores and warehouses should be stockpiling things. The demand should be lower with fewer people employed. You're not out there spending money on TVs and diamond rings and skateboards and whatever. You really need one of those things. But so you would say that the demand is low versus the supply. Prices should be plunging, and they're not. So what else is going on? Let's think, right? So somebody not working, not only is not spending money on someone else's stuff, they're also not producing anything right now, that's the secondary wave of inflation. There are shortages. They're just not realized yet. If you have a wage, it means you were making something. And the first couple waves of unemployment were people that weren't making anything. There were people that watch Netflix for a living, chimed on a Zoom call every once in a while. Now we're letting go of essential folks. Production's coming down. Companies are now feeling the tightness. They're actually lowering their production. Why? Well, because you have unemployed people not spending money, you can see that you're stockpiling goods. And the prices are maintained because you built them when they were expensive. You're not lowering your prices on wholesale. There's a lag time between when you built something and put it on the shelf when people are willing to buy it. It's the margin thing again. There's a delay. If you had a bunch of workers and paid them a lot of money 6 months ago, your prices need to reflect that to get a margin, get a profit. You raise your prices on the wholesale part. You already sold it. Now it's sitting on the shelf. Now you laid off all those people and so did all the other companies. They don't have money to spend. So now they're not going out there bleeding off that high-priced wholesale from 6 months ago, and Walmart's stockpiling everything that people would normally buy. Consumer discretionary would be the portion that would be getting hit the hardest. Staples maybe as well. I'm just looking at the sector today. But that would be what you'd be seeing, right? Like discretionary purchases. People aren't going to be buying the stuff, but the prices aren't just shifting automatically. There's a delay. Right? The store still needs to sell them to flip a profit or make the decision to lower prices. And that decision is made very slowly. You watch the market, lower the price, watch the market, lower the price. I mean, I run a corporation myself. I know how that works. You set a price. You can't just say, well, let's lower the prices tomorrow. You watch people respond, you change your price, watch people respond, change your price. So right now, the hand is in the retailers to lower prices of things. So people are spending money they don't really have. I was about to segue into borrowing. It's the last part. So people don't have cash to spend, and it's a little bit harder to get credit if you don't have a job. Fewer people working, the risk is higher, harder to get credit, or interest rates will be high. So credit slows down naturally when unemployment goes up. And Jay Powell says that all the time. The labor market will fix, will by nature of unemployment, destimulate lending and prevent lending bubbles, right? So people can't get credit that easily either, which is reducing the amount of money banks are making, which is reducing the amount of money they're able to have on their ledgers to lend out to other companies that are growing, which slows down growth of the infrastructure and marketplace anyways. People can't go get loans to start a new business, can't open loans to get a new house. So building slows down, enterprise slows down, everything slows down when people aren't out there handing interest money to banks because they're unemployed. So everything's slowing down. It's a general mechanic of recession. Why are prices still high? It's the lag of wholesale. The time when they were built, they were sold at a very expensive price, and that price just hasn't reflected yet. right? People got laid off in the last 3 to 4 months. Companies aren't just going to be like, well, I know we were selling this toaster for $12.99. Let's go ahead and lower prices to $9.99 because that's really what it needs to be to sell. They're going to lower it gradually to that level. Okay, it's $10.99. Let's make it $10.50. How about $10.20? How about $9.99? Companies are going to lower prices slowly, test the market little bit by little bit. So inflation on its own naturally has to come down when demand is down. It doesn't just drop to where it needs to be. Nobody's going to immediately sell their product at a loss. They just need to hang on and see what people are willing to buy it at relative to and then that's a slow change. So you're going to see CPI naturally will come down lower and slower. That's why. That's the effect. So the problem, the next problem is that people that aren't working are also not producing something. So now you're going to have a shortage of goods in the future as the market, if you understand what that means, right? If I had a job and I produce 100 things a year for this company and they already have 1,000 on their backlog that they sold at a high price wholesale to a store. So the store has to sell those 1,000 before they buy the 100 more. So in about, 6 months or a year, they finally sell those 1,000 and they look to the company and say, hey, we need 100 more. They're like, yeah, but we fired that guy. He's not here to make 100. But we can bring him back. You need 100. We need the person. And guess what? Prices will still stay high because the demand outweighs the supply. So that, again, is an inflationary mechanic. Is when you start laying people off during a period of surplus, the minute the surplus is leaked out, as slow as it is, when you go back to buying new orders, the company doesn't have the ability to create the throughput that's needed. It's a logistical problem. So prices don't naturally come down. Price will only come down when supply exceeds demand. And it's at this point, they are coming down slowly as we see in the CPI. The minute the economy recovers, people are going to be able to buy goods. They're going to go. So essentially, if you lay off an essential worker, it's less demand and less supply proportionally. They're making less. He's making 100 less things, but he also doesn't have a salary to go buy 100 things from someone else, right? So supply and demand almost come down proportionally, but people tend to spend less or produce much less. I'm sorry, spend much less than they produce. Typically, you're just a cog at your employer. They fire you. They still, you get fired from an oil and gas company. They still make gasoline whether you're there or not. Let's be real. But you're not out there spending $100,000 a year on stuff if you don't have a job. So typically the demand goes down and supply goes down at the same time, but demand goes on the consumer side goes down much faster. People are less likely to spend money than the production hit taken by a company laying off an essential employee. So you're going to see demand coming down a little bit, right? Versus the supply, which again will bring prices down, but only a little bit. And that's reflected right here. Only a little bit. So that's kind of how this all works, right? So what Wall Street sees this as is, okay, the market's going to hit an equilibrium. As long as companies don't continue to capsize, we don't continue laying people off, making that mechanic more muddled, weird, we're going to kind of hold the fort. And then, of course, you can just see how the mechanics of a short squeeze is still very prominent. I mean, the stock market doesn't crash and the banks are net positive. This doesn't happen. And the dealers are net positive. In any risk position, they don't crash the market on themselves. So the short squeeze is still there. Liquid market short squeeze. The short squeeze that we called at the beginning of the year, we said we're going to be a massive short squeeze, continue to float the market. Made a tweet, said October was the bottom. Mechanically speaking, here's your short squeeze all the way from April until May. This entire month, shorts have been squeezing. We predicted this. We've been saying short squeeze for months. There it is. Nearly 100,000 contracts. Net short change. So, and there's also genuine buyers here, right? People are parking their money in here. Stock market's popular again. Pretty cool to see, right? So the mechanic right now is that you would expect, if the Fed has reached its goals, you would expect that inflation month over month to be closer to like a 0.2, right? Because 0.2 times 12 is about 2.4, right? It's 2%, give or take. So around that 0.2 level, the Fed's hit its target. 0.4 means inflation's still there. There's tons of mechanics. I just talked about a couple of them. There's tons of mechanics. Prices don't change fast. That's why inflation's still high. The fact that inflation's not plunging, it just tells me as a smart trader that the Fed's not done doing what they're gonna do. So I'm saying maybe the Fed's gonna keep raising rates little by little by little to see if that has an effect. Or the gamble is the Fed gonna bet on the idea that people being unemployed will destimulate lending and lower things on its own? Because that's the last part of the puzzle. If people can go out there and borrow money, because anytime you take out a loan, essentially you're borrowing money from your future self at an expensive price. Your future self has to pay back your past mistake with a little bit of a penalty called interest, right? So is your future self going to have a job is what banks are going to ask when you try to take out a loan. Yeah, here's, I'm going to look at the first person, MK. I'm going to use using an MK right here wants to take out a loan. Okay, well, is MK 7 years from now, is that person going to have a job, pay this loan back, and have a little bit more money they do today? If you borrow money right now to buy something, it means you don't have the money to pay for it. So I got to bet that you're going to have the money to pay for it in the future, plus a little bit more. You're going to have your job and maybe have a raise. What's the risk of giving you a loan? And so as people become unemployed, the risk goes up and loans come down, and therefore the demand comes down versus supply and prices come down. So destimulated lending brings prices down, which is how the Fed throttles inflation to begin with. Higher interest rates directs participating bank deposits towards the Fed and not to the hands of the risky borrower. Therefore, you throttle the credit market. You can destimulate lending and prevent that type of inflation from the period where demand is well outpacing supply, and because you can lend out cheap money to people and people will borrow money to buy it because they need it right now. Demand is really high. So right now you can see banks are kind of struggling a little bit. Say lending's already kind of destimulated. Fed's also raising rates. So it's, there's not a lending spree. It's not easy to get a loan. It's not easy to get a credit card. Interest rates are going to be high. So, you're not really feeding into that credit market portion of inflation. But I still think there's certain areas where the demand is still outweighing the supply. Housing market's the easiest way to see that. So the mechanic of inflation is actually really hard to understand, and I'm having trouble wrapping my head around all of it now. It's very complicated. But the lag time and the logistical chain, I think, is the biggest idea. Inflation's coming down. The Fed doesn't have to do anything to make it happen. That's what I'm trying to say. As long as people are not employed, prices will eventually start coming down on their own. Stores will have to start lowering prices little by little to continue to make sales and push throughput. So the question I have now is, what will the Fed do? And that's the whole point of this conversation. The Fed is committed to rate cuts this year. We projected that they would go to 0 by April. May's come along. They're still raising 1/4 point, which means that the Fed is starting to continue to behave to control inflation. Well, obviously, they're not at their target. They're going to still push. But they don't. It means the Fed doesn't believe the natural mechanics is going to control things anymore. They're still not ready to let go. Why? I keep asking why. Maybe because they perceive that even at this level, the stock market's finding actual buyers, like genuine buyers, not just short squeezing. There are, since October of last year, genuine buyers. You remember my tweet literally said genuine buyers, and we literally predicted that. My tweet said, this is the bottom. I bookmarked it. Genuine buyers. And that's what you've seen. The net long has become more net long. This is the asset managers. Why are people parking their money in the stock market? Well, it's better than letting it lose 0.4% every month due to inflation. The stock market's so overshort and you can perceive a squeeze coming through. The dealers are positive. Any smart trader knows that the market's a better place to put your money for at least a flat run. Flat doesn't lose money. Like 4%, 0.4% a month. That's, Treasury's not a good place to go. You don't want a fixed yield. You don't want a fixed return. During a period of high inflation, your fixed return loses 0.4% a month. Stock market's a great place to park your money even at this time, and that's what Wall Street is telling you. We'll just put our money here in stocks, not risky small caps. not crypto, not regional banks. Let's put it in the shit that just proved that it worked. Tech, Apple, Meta, Google. Like banks and energy companies, a little bit less popular. Then let's just go long in Apple. Let's just put our money in the things that matter, that carried the stock market last time. Okay, let's just park it there temporarily. And that's what you're seeing. So let's reach in the comments. Did the event Catalyst training last week and it was very helpful today. Thank you. Oh, of course, no problem. Did the event Catalyst, very insightful, has not reached their goals. 25 basis point on 80% on the table for you. 25 basis point on the table. I think that we're still 25. The problem is if they just continue, if they start cutting rates, Wall Street's going on a frenzy and stock prices are going to go up. You think that's going to change inflation? Absolutely not. Right? That means our companies going to go back and hire all these people back, get them back to spending money? No, that'll make inflation worse. Because if people go back to work and start lowering the risk of credit, and banks start lending money to people again, people start buying these goods that are still marked up high to keep margins, right? And the prices of stuff are still high. You can't just throw people back into the workplace. They're going to go out there and get loans and continue to buy the expensive stuff, which is going to maintain inflation. So the Fed cuts rates, it's going to have the inverse effect, and inflation is going to continue on that mechanic. I have a delay, right? Not just Wall Street will go up and stocks will rally to highs again, and companies will probably saying, all right, we can hire these people back. Okay. So the Fed's not going to I don't think the Fed's going to cut rates, even though they said they're going to. They shouldn't. Not this soon. If they cut rates, they need to wait at least a year for the market to stabilize and prices lower on their own. They can't cut rates until that month-over-month inflation comes down closer to a 0.3 or a 0.2. And that's it. They're going to hold at 5.25 for 4 months. I 100% agree. 4 to 6 months. They're going to hold at least through next quarter earnings. Because next quarter earnings are going to be bad earnings. Fewer people spending money. Stockpile on the shelves. Wholesale is going to be down. Overall revenue is going to be down. Margins are going to be high. Companies had golden earnings this time around. They're going to have shit earnings next time. We all agree. The forward guidance is booty. You laid off a bunch of people. Your production's down. Your sales are down. You're leading in the quantitative tightening world with high margins. So that's where we are. Not a good place. So at least through next quarter earnings, the Fed needs to not do anything at all. The stock market's naturally going to pull back some more towards the end of the year. It's going to lay off more people, which is again going to propagate the recession further. There's really no easy solution here. Other than wait. The Fed has to wait. Crazy. They literally have to just wait it out. They lower rates, people are go back to work and can continue to spend money and get loans and buy high-priced stuff. Inflation goes up. They raise rates, continue to press Wall Street, more people get unemployed. Productivity comes down with high inflation, which is stagflation, bigger problem. Fed can't do shit. They're stuck. So now as a trader, the whole conversation is to tell you that's the answer. The Fed is stuck, which is why they're tapering to 0 rate hike. Y'all see that? MK is 100% right. We're going to sit at 5.25 to 5.5 until something happens. All right, do y'all all see that now? The whole speech here is to tell you the Fed can't do anything. Both directions hurt the problem or have a bigger problem. PPI is singing across the world, and Green Biceps nailed that too. The purchasing price index. So we may see deflation given the convexity of the drop of the producer price. So that's actually a really smart thing to say. I agree. We'll see. So the Fed has to just sit there and wait and hope that slowly prices come down on their own, which they should. So now you're waiting to see, is Walmart going to start lowering their prices? Is Apple going to start lowering their prices? If car companies start lowering their prices, housing prices going to start coming down on their own? Well, the more people that get laid off, less people buying stuff, the more desperation they are to sell things and assets they own, like houses, then they're willing to lower their prices further. House prices are still going up. People are trapped and they don't want to go upside down. You have to wait until desperation kicks in just enough where people are like, fine, I know I bought the house at $800,000, but man, I don't have a job anymore. I got to sell it. I can't get $850 for it. Can't flip it for a profit. Fine, I'll sell it for $700 because I can't afford it. Boom. That mechanic is what the Fed is betting on. Lay off just enough people, you push into the productive part of the workforce. Now companies are struggling, people are struggling. They're holding assets, they got to get rid of them. They got how much can they default? Or how much are they willing to lower prices for the default? People are like, let me hang on a little bit till I get my job back. Shit, more people are getting laid off. All right, I'm not going to get my job back. I need to get out of this before it drops further. Okay, I need to sell. And that mechanic will be what curbs inflation. The Fed can't do anything else. But you can't have too many people laid off or you collapse the economy. Right? It's like this balance, it's like this beautiful balancing act that just doesn't really have a good outlook. So you get people desperate enough, then you bail the banks out, they start loaning money again, market goes back to normal. Just like any other recession. So Fed's can wait it out. Ooh, I'm glad I'm not touching this thing here today. Ugh. Looking pretty nasty on that. Hedge break. You guys like that? Resilience negative. Oh, it's beautiful. But I'm still in the camp that the market's still going to rally over the next couple of months. Let's look at monthly map real quick. I love monthly maps. They're beautiful. Bull side still hanging in there. Bear side still weakening. I mean, just across the board. Let's look at QQQ, which is the stronger of the two. Bear side completely weakening. You can see that. The bear side's completely getting squeezed much faster rate. Bull side is even strengthening faster. The tech is going to be what carries this market forward. Beautiful to see that. Yeah, what a crazy... I love this crazy market today. Right, so Qs are still pretty strong. Monthly map showing increased bullishness to the middle of May, decreased bearishness. Slightly more volatile through June, and then, you know, next Fed meeting, of course. I like it. But yeah, irrational signals are a reason to touch this. It's looking pretty okay. I wasn't around yesterday. Towards the middle of the day, I was on this speaking at this like symposium thing. Was there are you guys having connection issues to refresh? You have to refresh to get your socket connected. Were y'all having connection issues yesterday? If y'all have that, please report it to tech support. Make sure I know about it, because we can look into it. Somebody said that they were having trouble and they had to just click refresh a bunch. Make sure you guys click this refresh button. It refreshes your socket. So there could be just, you know, I mean, obviously we're expanding so fast as a company. One of the things is we could just be, you know, we need to beef up our infrastructure a little bit. But don't just sit there and be like, man, you know, I got this problem. You know, let me know. obviously we're here to fix everything. So if I don't know it, and we don't address it, but if you guys tell me like, hey Matt, I'm having problems connecting, or the candles aren't refreshing or something, we'll look into it for sure. Always try a different browser too. Sometimes trying a different browser can immediately, like, temporarily alleviate the problem. You might have something go on your browser or on your end that slows it down, or disconnects you, or something. Anything can happen. There's a million things can happen that's out of our control. But also, if you try a different browser and that doesn't work, clearly it would be something implied that's on our end. I think like 2 people reported they were having trouble. Candles were like not updating. Still said market closed. We keep having to, well, obviously the thing is we're expanding so fast. We keep, getting faster machines and more machines. So it could still just be outpacing that. It could be one of the issues. Just watching this market today. Edge pusher break. Irrational. Easy peasy. DD's still 0.9. I think the bull side's prone to support. It'd be very, 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 very devastating for us to break out of the bull side. So again, like I said, I guess people are expecting the CPI. I said the market in my tweet yesterday, the market's be very sensitive to CPI because it's a reflection of is the market going to be, our price is going to stay high for a very long time? The answer is yes. that leak in pricing, I guess I'm out, the small leak of how much prices are coming down, it's just gonna be slow. This means market's gonna be very iffy about pricing and big gains for companies. Prices are still high and less people are working, so sales are gonna be down across the board next quarter. Easy to see that. Now, the thing I'm thinking about, it's really hard, is to understand is what the Fed is going to do. Usually it's easier to guess the Fed. It's not as easy right now. The Fed could still be pushing a quarter of a point on that's going to do anything. And I expect them to stop raising rates. They commit to cutting rates. It's a long commitment. They have to understand that's not you don't just cut rates for a couple periods. You cut rates and keep it there. So I think the Fed still needs to raise rates a lot. Do we stay in the bull zone with DD 0.89? The question usually in irrational markets, 0.90 is still enough to maintain that bull zone at 410. The question is, it breaks the rules for me trading the ETF account. Since ETF account, I'm very careful. If you guys remember when I did these ETF accounts, I did 3 of them back to back. It's funny, it's like I plan everything I do, right? I did it one time, and I'm sure people would be like, oh, that was a fluke. I did it 3 times back to back. One, nailed them all. That whole process, just to show, like, took my time, got there, showed the stats, tweeted all the statements. Now, the way you handle the funded part of the account is your first trade must be your best trade. I'm just waiting for that perfect signal to go. 150 is the starting point. I'm down 200 bucks. Been trading like a little bit because I have, again, bear market. You gotta be careful. So I'm waiting for my first trade, just my first trade. To build a little bit of a buffer. A couple grand, just enough to get off the hole, and then you trade normal. It only takes 5 days to earn one. So statistically, we did the math. We did a whole session on the math. If I try to inch my way forward for the first trade, statistically, the goal is to get 10K the fastest, right? You have to trade it there slowly. In the time that you're waiting now, I should be getting another funded account and getting another funded account and just have a couple stockpile on the back end, technically just so I can have a couple extra shots. When I get that perfect trade that I want, the maximum position size is 4, so I'll trade the max position size. It's a normal allowance. Get a 10 or 15 point move. Put a couple grand in that account. So 150 becomes 152. And then you just normally trade. What it does is it gives you enough buffer that in case a market catalyst drops you. We did a calculation on how quickly market catalyst happened. Market catalyst happens, so many times a month. The chances of you being in a position when that catalyst happens and blows up your account no matter what, just on an unlucky coin flip. So then you got to start all over after 2 weeks of work. The better solution is 5 days, get the account. Just wait and take the highest probability first trade just to put a buffer such that when that lightning strike catalyst happens, it doesn't bust you because it's a static drawdown. You just need to lift further enough off the starting point that you don't have susceptibility that a single catalyst will drop you. Like right now, if I'm in any trade right now, a catalyst that comes out of nowhere will bust the account. So I have to make sure that I trade in the squeakiest, cleanest, least risk trade I can find. I need to find the perfect setup. And statistically, that's the best way to go. I mean, every single thing I've planned and done has worked like a charm. So you gotta trust me on that one. Can't argue with the broker statement. I posted up on Twitter. And refresh market. Okay, that's cool. Well, we're gonna look and see if we have any connection. I should look into it as well. So like irrational market, I don't touch this. I'm waiting for that perfect little bull long up of the market. That's a really good run. Don't take a long up of that. And I don't short. I never short in funded accounts. Shorting is playing volatility. Volatility leads to drawdown. Again, drawdown is the enemy of a funded account. The trick with these things is a puzzle on how to beat them. That's not, you don't normally trade. It's like ETF accounts, right? Or any kind of funded account. This is not something you do for a living. You don't try to make a living trading these things. They're starting points for traders. The whole point to show how I would beat them is to give people instruction or guidance on how to approach it. I don't trade my normal account the same way as I trade this. The rules are much tighter, much stricter. There's more of a challenge. You have to understand the math that goes behind it. So the statistics of, what's the probability that you're right on your position? What's your confidence? Confidence to be really high for your very first trade in the funded account. So I'm just waiting for that perfect setup. And then once I do that, then you'll see me make trades pretty much every day. But the first trade is the only trade that matters for me right now. First one's got to lift me right off the starting point. RDD ban, same as yesterday? No, they changed. So, it's not, there's no gambling whatsoever. So I think it's going to go up. Maybe I should take a trade. That's not how you trade the funded account. The funded account goal is to build yourself a small bankroll so you can put it into a real trading account, trade it on your own. The idea that somebody would do this for a permanent income is not smart. You're going to give away 40% extra of your profits if you make any to the profit split, give or take, and Uncle Sam's going to take a little bit more than your futures account. You lose the 60/40 tax benefit. $90-10 split. Yeah, either way, your goal is not to give money to Uncle Sam if you don't have to, as much as you don't have to. and you don't want to give money to the Apex or the trader funding program that you're splitting it with. Futures have the benefit of giving you the better tax structure. You want to take advantage of that. Splitting the money with the prop firm essentially is like it's like day trading stocks. You're essentially on your income level tax bracket. It counts the same way. You lose that long-term capital gains benefit. It becomes a 60-40 rule. So now it's like the idea is this is not something a normal trader would bank for their income on. A trader that's just getting started, that has a couple $1,000, has a couple paths to go. There's some products you can trade in the futures world that are very cheap. They have nanos. They have these new binary futures options things that the CME just put out. Seem pretty cool. You can trade with like $20, $10. Fixed risk loss. I was reading about them. Interesting. It's a new CME product. Different ways you can get in, but most traders tend to take their couple $1,000 and get into something very risky, like penny stocks or crypto or options. And this process is to introduce them to futures. You have $2,000 to your name. Well, at $150 a month, you get an attempt to get a funded account that you can get your first $12,500 paid out to you with no profit split. You can pay higher taxes on it, but whatever. But there you go. You just seeded your real trading account with that money. Immediately pivot to your own trading account. And that process is what I'm trying to make a video series on. The most careful, cautious way to turn $150 into 100 grand, which is what I'm filming right now. The first trade is the most important trade, which is why you're seeing in this ETF. You see me wait and wait and wait and wait and wait, and that's what you should be doing. If you're doing this, you should wait. That first trade is the most important trade. You need it to be the setup that just is arguably, in your opinion, you are so confident in. You know it's gonna win. Catalyst is invalid, no longer have an effect on the market. You nailed it. Good job, Zach. You nailed it. So yeah, we closed out the on the S&P. We have closed out the anchor point for the for the event. So now it's non-event, correct? My favorite setup for those first trades. You ready for that? Okay. DD bullish, resilience bullish. All lights in the alerts are green. So rational market, strong DD, strong resilience, bull long up, bounce up a hedge pressure. Last Friday's trade. Everyone remember last Friday, Jared? When I was in Florida? Damn it. That's the trade I was waiting for. With plenty of room to move, right? To fill a gap or to hit a DD band. So base called the golden setup. You have perfect influence, DD resilience, liquidity maps up, and I trade off of something. Not just chase a green candle, I trade off of something. So it needs to fall to a hedge pressure or fall to a half gap or fall to the open or close price if there's a gap. And I trade off of something to something and I hit it hard and then I close it fast. That's it. So that idea is that you have your 150K, I wait. It only cost me, what, $150 a month? Or I don't remember how much I paid for this thing. Let me look. How much did I pay for this? Oh, $300 a month. Yeah, that's right, 300. Okay. So, spent $300. Now they give me a funded trading account. I got it in 5 days, so it cost me $300 to get it. No resets, nothing. So for $300, now I'm trading with a funded account. If I lose, I just got to reset and start over. Another 5 days, I'm back in the game. If I try to inch forward 1 week, 2 weeks, and just get dealt a bad hand, 2 weeks later, I got to start over, and there's 5 more days. That's 3 weeks I got to wait to get back in the game. If you wait, so you're waiting 3 weeks anyways, might as well wait 3 weeks and not reset. That's what I'm saying. You have to wait to make your first trade your best trade. Because if you just inch forward, and get burned on a catalyst because you're always trying to day trade or over trade, you got to pay the reset and get back in. It costs you more than $300. So once you've earned the funded account, you are not pressured to make any trades. Then don't make them. You make that perfect trade that lifts you off the starting line. You have $1,000, $2,000 of fat on the account. Then you can trade every day a little bit more risky because you're trading smaller, 5 micros, 1 mini. They give you 4, trade 1, something really small. Just enough that a catalyst of 30 points, which is $1,500. Remember, one contract is $1,500 loss on 30 points. If you are at 150K and a catalyst happens and drops you 1 risk interval, what happens? You bust. You lose 1,500. 12,500 is the drawdown. So you cannot be in a trade unless you are sure it's going to work and you're sure there's no catalyst. You need to lift up at least $1,500 such that a 30-point drop doesn't nuke your account. Does everyone understand that rule for these trader funded accounts? It's a very, very beautiful rule. Everyone in chat, really quick. A catalyst is measured by what amount of move? What we tell you in Rocket Scooter? Every time there's an event, what do we call a catalyst? If it goes more than what? Risk interval. What's the risk interval number right now? $69. What is? Do you guys know what the risk interval is right now? Yeah, quizzing you guys. 31. Okay, let's draw a box at 31. Look what happens when you have an event, right? 31 is the magic number. Let's go back to... I'm just going to estimate where I think it'll be. Let's go to a tick chart and double check. 25 tick chart and double check. So that doesn't qualify, that doesn't qualify, that probably qualifies. Okay. Let's see if I got 31 point. Oh, there it is! Oh! Woo! Look at that. Look how clean that is. All right. It's beautiful, right? Okay. Let me show you this right here. Did you guys draw this today? Did you get your anchor points right? Who picked that right anchor point? Who started at the bottom and got it wrong? Your anchor point was exactly here. And look at that anchor point right there. It was a non-event already right there. Did you get it right? Did anyone else get it right by starting from right here? Was this your anchor point? 4138, congrats, you got it right. If you started from here, you did it wrong. Yes, sir. Itai, you guys got it perfect. And there's your catalyst, right? Catalyst, event, non-event. Okay. So there's your risk interval. The idea that the market can push 31 points against you, then one contract is 1,500 loss. At 150K start, you already go bust if one event pushes you. So therefore, you must sneak in and sneak out fast enough and put at least 1,500 to 2,000 in your account. So you can survive your first catalyst if it's your second day or later. Do we all understand that's why I have that rule? It's such a beautiful statistic to understand that a catalyst moves 31 points or more or less. That's the target, right? So imagine you're at 150K, you've had one contract, right? And an event happens. Well, this is a scripted event. We know the CPI is coming from a mile away. We'll have somebody tweet something. Fed says something, and all of a sudden the market drops like it did 2 days ago in the afternoon, right? If you have one contract and the coin flips against you, you bust your funded account. You can start all over. Isn't that crazy? So therefore, you must not trade around events. You must only trade when you are certain that you are not going to have bust on your first trade. So anything more than one contract, you go bust right here. If I were short and it goes like that, I go bust the very first day. So your first day has to be a non-event day, because remember, it's $500 for every 10 points. So 31 points clearly is 1,500 or more, right? A little bit over 1,500. And 1,250 is the loss. That's where you get squeezed. So I have to take a trade that I know, a trade that I'm confident in, no event, no catalyst, and just hit it pretty hard out the door. They give you 4, I'll hit it. If I get that perfect bull setup, I'll hit it with all 4. If I'm halfway confident, I'll hit it with 1 or 2. But I'll get in and get out and try to build a quick 1 to 2,000 on the account, right? At least 1,500 or more. Just so that I have 152 the next day, and then I take my normal trade of 1 contract, and then a 30-point drop only drops me to 150. As a matter of fact, and you guys see me do that early on, I did build this account to about 152, and I got nuked on a catalyst the other way around, and now I'm back to start, but it didn't go bust. That trick is what kept me in the game, and that's how it works. Again, my first trade around the 150K, got to put it to 152, give or take, trade it like normal. The coin flip comes your way, you get a second chance to survive, which you guys are seeing me right here. That plan is designed to catch me with the safety net, just if I get an unlucky dice roll. Do you all like that? Is that pretty cool? That's why you see the account sitting here at 149.8, and I'm barely touching it. It wasn't like 152 or something like at a point, right? I did my strategy, put some fat on the account, but then it's got an unlucky hand dealt. But the unlucky hand didn't bust me, and that's what we're going for. So it's basically like I get a second chance, and I'm gonna make sure again I wait for that first perfect trade. Again. Critics aside, don't let their lack of understanding of math and statistics fool you. This is a brilliant way to approach this. But don't take my word for it. Just look at my trading stats. I love the idea that my critics watch my stream every day. Maybe they'll learn something about trading. I don't really have that many critics either. We have like a couple weirdo stalkers, but other than that, I think everybody understands. Can't argue with the stats you see. You haven't made it, so you have haters, I guess. Yeah. Regarding the commitment of traders, how to use the COT-LC to analyze potential direction. I don't really use the LC anymore. I know I get a lot of pushback from that. I think that in the TFF report, the TIF or the FTR, is so much more valuable to positional risk. James John, you nailed it. Like the LC is more useful to you if you are in the commercial industry. Like as retail traders, the LC I don't think is as important. If you're trying to hedge, your crops, or you're trying to hedge your barrels of oil and things like that, you're going to want to understand all the mechanics of the red line up in the LC. This is your logistical part of it. Producers, merchant, processor, user, right? This is the production side of things. Non-commercials and small spec, right? This is more of understanding the supply and demand of the spot market and the positions and hedging inside of that. I would say this is more useful to like actual dealers of the commodity than like traders like us. This is showing where there is no segregation of like who these dealer intermediaries are, right? So the idea is that I don't use this a lot for big decision making, other than understanding the supply and demand of the commodity itself. But I don't go that deep in the S&P, because the S&P doesn't really have a physical commodity. So like if you were trading oil, for instance, it would be more important to understand like the spot market in oil. Like if let's go to CL really quick. Like to me, it gives you a little more detailed picture, kind of what's going on. Like managed money is a little bit more long oil futures. Small spec is a little bit more long. So speculators in general, the blue plus the green, are net long against the commercials that are short. So it just shows that people are selling oil and people are buying oil. So it's like, okay. But as far as like the positional risk, like of the actual futures market itself, it's really hard to see that in the LC. So other than giving yourself like a more fundamental basis, I don't really use this a lot with the S&P. Like I don't use it at all. So commercials like producers, merchant, processor, user. What do those categories mean? So it's a great question. The processor part, the easiest one to understand is oil. Commercials. Okay, ready? So oil, this is an oil derrick, trust me. Here's your drill. You pull oil out of the ground. You're a producer. You produce the good. You produce the commodity. You either retrieve it, you find it, you dig it up, you make it. You grow the crop, you pull the oil out of the ground, you're a producer. Merchant is someone in the middle who you sell your like wholesale commodity to, the merchant, the middleman, and then they sell to other people. And your merchant, this is your midstream, like you remember, like midstream facilities. They buy oil from the oil companies and then distribute it to the production facilities. Processor, user, what are the difference? Well, merchant's going to sell to both of them. Merchant's going to send cash this way. These guys are going to send cash this way to the merchant. Merchant buys, sells, easy peasy. Producer, user. Well, let's think about this. A producer is somebody, let me say a processor, user. Processor would be like a refinery. You take the oil and then you process it in other goods, right? So take the oil, you can make gasoline, diesel, kerosene, you know, olefins, you know, precursors to making plastics, whatever. Like all that stuff. A user is going to be somebody that uses the commodity straight up. And you don't really use oil for anything. You take a bath in it or eat it. But like if this was oranges, like a producer would be a farmer that grows oranges, and a user would be a grocer. You sell it to somebody who buys the orange and eats it. A user is someone who destroys it. So a producer makes the commodity, a user destroys it. Producer bananas makes bananas. A user bananas eats the banana. It's gone. Make it, destroy it. Change it to something else. Sell the wholesale thing as it is. Sell the raw material to either one of these categories. So somebody's going to take the thing that you buy and either process it into something or use it as it is. And so that whole chain is this red line. So the idea is that, okay, so if there's any interruption in this red line, you're going to see either one of these categories does a lot of hedging. You're an oil producer. Okay, well, you're going to be selling oil contracts maybe if you don't have a broker that's selling your oil for you. You just short to the open market or short to the commodities market, and whoever buys those contracts is required to buy that oil from you. And all these people are hedging their inventories and hedging their demand. So these people need the oil. This person needs to get rid of the oil. This person needs to balance the supply and demand with what's available and hedge in the middle. So all of these categories are either buying or selling the commodity or maybe buying or selling the contract just to give yourself some hedging. So the idea that this takes place where a lot of this dealing takes place in the spot world, right? You don't see that on your charts. You don't see that in the volume. You don't see that in the time and sales in a trading platform. Because an oil broker, you just pick up the phone and call somebody and say, I need to sell 10,000 barrels of oil today. And he's like, oh, I got a guy that needs some. I'll give him a call. And you just drop it off and he sends you the money. That trade is not captured in TD Ameritrade. So the fact that a lot of that hedging takes place with the actual commodity, it escapes your visibility. So therefore, its usefulness is not as good as the TFF report, because that is strictly showing how the hedging is divided up. It doesn't matter spot world or not, all the hedging of contracts, this is the positions of the contracts themselves are divided here. It's really hard to see if this red line is going down, well, which one of these companies is accumulating the net short? Which one of these companies is selling harder? Is the producer selling more, right? Is the merchant shorting to hedge their inventory? Maybe the merchant has their tanks are full and nobody wants to buy from them. So you're sitting on inventory As prices are falling, well, shit, let me short some contracts just to hedge my inventory. Because if prices are falling on my inventory, then I bought all this oil that's losing value. Holy crap, well, I shorted the market, so I'm okay, I'm hedging it. So, like this red line, who is that? This could be somebody is selling more oil because the demand is up. Somebody's stockpiling oil because the demand is down. Value's coming down. You can't easily see. One of those is very bullish and one of those is very bearish in that red line. To distinguish which one it is, you have to say, well, are the speculators buying or selling this thing? Well, if this is the case and the speculators are going long, then you know it's the bull category. Demand is up. So somebody's probably selling more of that material because people are betting long that thing. Oops, my bad. Hold on. Oh, I'm such an idiot. My bad. Why am I doing this? Okay. Okay, let me draw here. I didn't see any of that. I'm such an idiot. Okay, here. Okay, so red line, 2 green and blue lines, very simple. Commercials is producer, merchant, processor, user. Okay. So basically what I was trying to tell you is that the red line is going to show who actually in this logistical chain is buying or selling that thing. This red line is coming down, right? It means people are going more net short oil contracts. One of these people are shorting oil contracts. Now, if you produce it from the ground, you can sell it to somebody that you already have a deal with and not have to even sell it on the futures market. You just sell them the oil and they give you the money. But if you want to sell in the futures market, that would be the contract is represented here. So somebody's going more short oil. If you're a producer, it means you're selling more. If you're selling more, it means demand is up, right? Demand is going up. You're producing more and selling more. So you're going to be shorting more contracts. However, if you were a merchant that's holding inventory like in a tank, like say like a merchant right here, you bottle this oil and now you're sitting on it and demand is down. You bottle this oil and demand is down and oil prices are falling. Well, you're going to short the oil market as well to protect your inventory. Anytime you stockpile an inventory, you should short a contract against its value to maintain its value. Imagine if cars naturally depreciate, right? The minute you buy them. Imagine if you could buy a car and the minute you buy a car, you can go short your car in the car market. There's nobody stupid enough to take the other side of that bet. That's why that contract doesn't exist. Imagine you can short one car. And as your car depreciates, your short goes up in value. And look at that. You maintain your car's value out the door. Isn't that crazy? It'd be great if you could do that. But again, there's nobody stupid enough to take the other side of the bet. But that inventory middlemen, like oil midstream companies, hedge their inventory all day long. You bought oil at $100 a barrel and oil prices are starting to fall. Well, you shorted an oil contract at $100 a barrel. You force somebody to buy it from you at $100 a barrel, no matter what. So the fact that you can short against your inventory when there's no demand also could be that red line coming down. So the first approach is if this red line is coming down because it's the producer, demand is up, they're selling more oil. So they're going to be shorting more contracts to sell that oil. Demand is up. But in the case of the stockpiled merchant, when prices are coming down, they're also shorting oil to hedge their inventory. So with this coming down, it's not so clear to see, does that mean the demand for oil is going up or the demand for oil is going down? Which one of these folks are doing that? Now the processor and user, the people that buy the oil, they're going to have a net effect on this as well. So if this isn't coming up, then they're buying less than this person's selling, and the person in the middle is the one that's shorting the inventory. So which one is it? Demand is up or demand is down? It could be both of those cases. It's not so clear, which is why it's harder to use. Now you can make an assumption is that, well, these green and blue lines are going up. These are your non-commercial large speculators. So this is your managed money and hedge funds. And these are your smaller speculators. So these are the people that are buying the commodity. These are the people that are not buying the commodity. These are just speculators. They have no intent on owning the product. So now you can compare these two lines, blue and green. Well, the speculators are betting long the market. So therefore, I've isolated the idea that they're going to bet that demand is up against the supply. Why would you long the market if the demand is down? So now this paints the picture that the answer is producers are selling more oil and demand is going up, and that's what you see. So the only answer you have from this top one in oil is that producers are likely selling more oil. Maybe oil prices are going up, or people are betting the oil prices are going to go up. And that's basically it. You don't understand the positions of the logistical chain or the positions of the market makers against the bet. These categories are further differentiated through here. Well, actually, both of them, this one as well. But your market makers, your asset managers, your hedge funds, they break it up even further. Gives you more detail on who's actually betting, right? How demand causes them to short? Well, when you sell a contract, you sell one contract, right? Minus one oil contract. Means you owe 1,000 barrels of oil to whoever bought that contract of you. So pretend that you are a farmer and you produce wheat and you sell your wheat to General Mills and they make cereal. What if the demand for cereal is down and General Mills is no longer buying your wheat and then your wheat just sits there and rots? You short a contract against that lower demand of cereal. You force somebody to buy your wheat. Whoever bought that oil contract from you from the open market now has to buy your wheat from you. It's a contract. It's just like an options contract. If it's in the money you exercise, you own the contract. You have a contractual right to buy that thing. An oil contract in futures is the same way. If you are short an oil contract and that contract ceases trading and expires, and you are short that oil, you are short that oil contract against somebody, and they are required to buy that oil from you. So if demand is up and you're a producer, what if you sell 10,000 wheat? I'm just making a random number, 10,000 wheat to General Mills, and demand is up, and you decide to up your production to capitalize on higher demand for wheat, not just from General Mills, but from anyone else. So you double your production. Well, General Mills is throughput is fixed. They can't produce any more of your wheat. They can only take so much because they can't produce faster. So what are you gonna do with your extra wheat? You're gonna sell it to the open market and make other people buy it at the higher price. So you'll start shorting contracts. Changes the demand of your product if you produce the raw material. Does that make sense? Shorting a contract forces somebody to buy your goods. You make something and you short the contract. Whoever bought that contract has to buy that thing from you at whatever price that contract is expiring at. You follow, Zach? So how demand causes somebody to short, the producer is short. The seller of the item is shorting the market to force someone to buy it. An example is an oil refinery can only produce 100,000 barrels of oil a day, right? There's like an example of one. That's like the one I've worked at a bunch of production facilities. They're limited by how much they can produce. The machines are only so big. The tanks are only so big. So if a refinery can only do 100,000 barrels a day, but the person that they buy their oil from is now ramping up production, they put out some more rigs, drilling some more oil. It doesn't mean the refinery can now produce more. You throttle how much you can produce. They're designed to produce a certain amount. You can't just pump more stuff into a refinery and make more stuff. There's a limit to production. So what are you gonna do with all this extra oil you drilled? You gotta sell it to somebody. Well, the futures market allows you to sell it to somebody. There's a willing buyer in the futures market. Then somebody will buy a contract from you and they buy your good. That makes sense? Yeah. So the idea is that this upper one just tells you more of supply and demand of the commodity. Somebody is shorting the market. So either somebody's shorting their inventory because demand is down, or somebody is shorting their extended production of the raw material to force more people to sell. And that question is answered by, are these blue and green lines going up? Are the speculators actually longing that thing? Then why would you only, if you're a speculator, you have no intent on buying the oil. This is like you and me and market makers and hedge funds. We're all the blue and green lines. These are the people making the stuff. So if we're in general net long this thing, or our net long is increasing, then as a whole, traders are net bullish that thing. You're only bullish a thing for one reason. You believe the value's going up. So therefore, if the value is going up, the demand is outpacing the supply. You follow, Zach? That's the answer to that. And that, again, the top chart really just helps you see that, in general, Wall Street's slightly more bullish on oil right now in May than they were in March. And as you see, somebody's willing to sell more oil. It likely means production's ramping up. That's one of the things. Maybe production's ramping up. or maybe demand is going, and people are selling more, or demand is going up. If these green and blue lines were going down, it would likely tell you that the merchants are stockpiling inventory and demand is down, and then they would be shorting. If the red line's coming down and these lines are coming down, then that's the result of that. Stockpile is up, people are shorting, nobody's longing that thing. All of them would be pointing down. If all of them are pointing up, it means there's a demand surge. People are very bullish that thing, and the end users, processors and users, are buying those contracts to ensure they get that thing, and that's a shortage. So all three lines pointing up means a shortage of the commodity. All three lines pointing down means a surplus of the commodity. And when they point different directions, it's okay, slight bullish, bearish changes. Market slightly more bullish, production slightly going up, demand slightly going up. Is our oil price is slightly going up right now? I haven't looked at oil in so long. Let's double check. Over the course, and I say slightly going up, over the course of March till May, they have been going up slightly. Slightly going up. There you go. Nailed it. Any questions? That's what it does. This kind of tells you supply and demand of the commodity versus supply and demand of the instrumental on Wall Street versus how prices are changing. And you can make that slight assessment. I haven't looked at an oil chart. I wasn't cheating. I said prices have been slightly going up, and there you go. Right? From March till May. And that's how you do that. So it's a good way to like understand that mechanic, but it's not a good way to understand how the positions are further subdivided, right? And so analyzing the commitment of traders is something that I always encourage any trader to master. It isn't, you just build these relationships and understand what each part is. It's really neat to work on that. Oh, actually, I guess I did see that. I didn't actually consciously look at this chart, but I guess the chart is right there. But yeah, price is slightly going up, and it just tells you that. I guess this is the oil prices, but I didn't cheat. I promise I didn't look at that. But that assessment's pretty cool. But what you really want to see in the TFF report is okay, asset managers are, they were longing that thing, and now they're less long. They have less confidence in the price going up. Okay, the leveraged funds are now starting to short oil. Remember, this green line and blue line are also further subdivisions of these green and blue lines. There are people that aren't going to hold the commodity. None of these people are going to hold the commodity. These are just the futures traders. So market makers are now shorting against the net of the other three. So hedge funds are becoming less long. Another thing to note, it's the largest commodity pool in the world, leveraged fund, is the USO itself. So the reason that you'll see oil, like that blue line, is the hedge fund is a net positive. The USO traditionally is a net long on the oil market. The USO is the largest commodity pool in the world. This thing you see right up there on my rocket shooter chart. And so they're a big holder of oil contracts, and that's mostly what causes that blue line to be positive. Most hedge funds that can trade inside the market. As you see, oil is traditionally reversed, as it has a very large commodity pool holding the bulk of the liquid, or the bulk of the assets. They're the ones that are the strongest, and the USO is just a massive fund. Yes, we're here. So, like, when you're trading the S&P futures, as there is no physical commodity delivered, that top chart, as you see, the futures, it has no, there's no reason to even care about it. It doesn't really give you much info. You can't really make that kind of assessment. There's no processor and there's no user. Traditionally, everybody's pretty much in this merchant category, I guess. But I mean, in reality, this I don't find useful at all. It's mostly just mechanical noise. You can see that the non-commercials are large spec, right? And the small spec put together. It can kind of tell you, smaller speculators versus larger speculators, like who really has faith in the market. Like I said, I don't use this a lot. As you see, the commercials are swap dealers. The swap dealers are the ones that you really care about here. Sorry, this is not the merchant. Sorry, swap dealer. So swap dealers are becoming more net long. That's a little more complicated mechanic, but you can understand most everything from this part of the report. All right, y'all just chilling out. No trade today. Taking it easy. Gonna call it. Gonna go chill. What do you guys think for today? How are you looking at the market? That bull side held pretty good, right? DD's hanging in there pretty good. That bull side support hit that half gap. I don't know if I like it anymore. Honestly, the rest of the day doesn't really have any to me, it doesn't really have any more push. That Nasdaq resilience being positive is really strong. This is from, remember I told you guys to go long from earlier. I forgot that much. I know this. I lost $800, nothing big. So the 10K account is down to $800, no big whoop. It's up to almost 66,000, 65,000. So now down $1,000. That's it. Took that initial loss off of the hedge break. No big, lose small, no big deal. Yeah. That's a nice bull support. DD positive, resilience negative. It's clear there's resistance. I don't dislike this market today. Too bad, but I think Nasdaq being upper DD band is probably a limit today. What do you guys think? Hi, Matt. Do we ignore overnight hedge pressure when you get in intraday? Yeah. So the overnight hedge pressure is something to give you something overnight with the best estimate we have with their dynamic model, the best you can get overnight before Opera releases data. So we try to get ahead of the Opera data by estimating what it will be. It's a real-time dynamic model. So after that, in the morning, the real hedge pressure calculation is done, and that's what you use. So overnight dynamic, it's between the overnight session and the morning session. Gap fills, yellow line, red line, automated, and rocket scooter. That is something that we'll have to tackle as soon as we get futures data going. All right, we'll see you guys later. Gotta bounce. Just down like a measly $100 on the hedge break. I don't know if I'm gonna do anything. Resilience goes positive. I might try to take a long. Remember, there's a hedge break. There really is no mechanic for me to want to continue to trade this, this environment. It's just a little. It's just, you know, this is a return point. Obviously, the bull sided there is a good, strong, long setup. Resilience is negative. There's resistance there, support there. This is a pretty easy leg to see, right, with rocket scooter stuff. You also have index divergence, which, again, is not... All right, y'all. See you later. I'm Maddie. I'm gonna call it a day. Oh, you took the bottom bull zone back to half cap. I contemplated doing that. I just didn't do it. It wasn't a bad trade. Good deal, good deal. Nice job, KV. Nice job, everybody. You guys are killing it. I love that y'all are making trades on your own. This is the best part about Rocket Scooter. Y'all aren't sitting here copying somebody's trades. You aren't here sitting here letting some guru with the God complex try to convince you they're God's greatest gift to cupcakes and trading and everything on the planet Earth. You guys are making decisions on your own. Means you are learning how to trade. While I'm sitting here rambling on about the community of traders, you're out there scraping out a living for your own. That's empowerment. Rocket Scooter's here to empower traders. Making your own decisions, making your own trades. There's no signal here telling you what to do. You made that decision on your own. That's fantastic. You guys know the rules. You know how to trade. Y'all are killing it. I love it. Love it, love it, love it. Y'all make me so proud of y'all. Killing it, guys. All right. We will see y'all later. This has been a great day. It was a great day in general. Feels good. Even feels good to take a small loss. Get in, get out. No big. All right. We'll see y'all later.